Most people think the financial system rewards intelligence, or discipline, or hard work. It doesn't. It rewards one thing above everything else: expansion. And if you don't expand, the system doesn't just ignore you, quietly pushes you out. That sounds dramatic, but it's not a metaphor. It's math. Right now, somewhere in the world, a perfectly healthy business is being punished. Not because it failed, not because it made bad products, but because it decided not to grow fast enough. And at the same time, a much weaker business is being rewarded, given cheaper money, better terms, more attention. The difference isn't quality, it's direction. One is expanding, the other is standing still. And modern finance has no patience for still. This matters right now because we're living in a moment where growth is slowing everywhere. Populations are aging. Productivity is flattening. Markets are saturated. Yet the system we're all inside still behaves as if infinite expansion is normal, expected, mandatory. So when expansion slows, the pressure doesn't disappear. It concentrates. To understand why, we need to strip finance down to its skeleton. No jargon, no charts, just incentives. Imagine a very simple world. There's a village, there's one bank, and there's money. The bank doesn't create value, it creates promises. When it lends money, it isn't handing over stored wealth. It's creating a claim on future activity. You get money today. The bank gets a promise that tomorrow will be bigger than today. That promise is called interest. Interest is small when things grow fast, and heavy when they don't. That's the first uncomfortable truth. Debt assumes expansion, not optimism, not confidence. Expansion. Because if the future doesn't get larger, the extra money owed has nowhere to come from. Now scale this up. Replace the village with a country. Replace the bank with an entire financial sector. Replace people with corporations and governments. Nothing changes. Every loan made today quietly demands that tomorrow produces more than today did. More output, more income, more transactions. This is why expansion isn't just encouraged. It's structurally required. Let's talk about companies. A company that grows revenue by 3% a year is considered stable, safe, boring. A company that grows 15% a year is considered exciting, visionary, worthy of investment. But here's the irony. The fast-growing company often loses money. The slow-growing one often makes it. Yet capital flows toward the one that expands. Why? Because financial markets don't price today. They price tomorrow. Stock prices are not a report card. They're a forecast. And forecasts reward movement, not balance. If you're expanding, investors assume future cash flows will be larger. If you're stable, they assume those cash flows have peaked. This is why companies obsess over growth metrics even when profitability is weak. Why user numbers matter more than earnings. Why expansion into new markets is celebrated even when margins collapse. Expansion buys time. Stability runs out of it. Now zoom out again. Banks don't just reward expanding companies. They depend on them. A bank's balance sheet only works if loans continue to be repaid with interest. That interest doesn't come from savings. It comes from economic activity, which means the bank needs the economy to keep growing just to stay solvent. This is where the system becomes quietly fragile. Because when expansion slows, risk doesn't spread evenly. It piles up. Imagine an economy growing at 5%. Debt feels light. Mistakes are forgiven. Defaults are rare. Now imagine that same economy growing at 1%. The math flips. Debt that once felt manageable becomes heavy. Margins disappear. Refinancing becomes harder. Suddenly, everyone is fighting for the same limited growth. And the financial system responds by doing what it always does. It rewards the fastest expanders even more aggressively. Cheaper loans. Higher valuations. More tolerance for losses. This creates a strange outcome. The system becomes less about creating value and more about signaling expansion. You don't need to be strong. You need to look like you're growing. This is how bubbles form without anyone intending to create one. It's not greed. It's alignment. Every player is responding rationally to incentives that punish stillness. Now let's talk about governments. Governments borrow too. And when they do, they make the same promise: that future economic activity will be larger than today. This is why GDP growth matters so much. Not because it measures happiness, but because it measures debt survivability. A growing economy can carry more debt without panic. A stagnant one cannot. So governments design policies that favor expansion. Lower interest rates, tax incentives, infrastructure spending, credit support. Not because growth is always good, but because contraction is politically and financially dangerous. Here's the quiet humor in all of this. We talk about stimulus like it's optional, like a boost. In reality, it's often maintenance. The system isn't being pushed forward. It's being kept from falling backward. Now comes the uncomfortable math. If expansion is rewarded and contraction is punished, then slowing growth doesn't lead to stability. It leads to concentration. Large players with access to cheap capital survive. Small players without it struggle. Markets consolidate. Competition thins. Ironically, the very system that claims to reward efficiency often rewards size instead. Because size signals resilience, and resilience reassures lenders. This is how expansion quietly shifts from innovation to domination. The hype says growth means progress. The reality is growth often means survival. And sometimes, survival comes at the cost of resilience. When everything depends on expansion, shocks become more dangerous. A missed quarter matters more. A slowdown triggers fear faster. Pause feels like a threat. This is why markets overreact. Why corrections feel violent. Why calm periods end suddenly. The system is always leaning forward. Now zoom out one last time. What happens when expansion genuinely slows for structural reasons? Not a recession, not a cycle, but demographics, resource limits, productivity ceilings. The system doesn't gracefully adjust. It strains. Debt loads feel heavier. Financial engineering replaces real growth. Risk moves into corners no one is watching. And the reward for expansion becomes even stronger. Not because it works better, but because the alternatives are worse. So here's the final uncomfortable question. If our financial system only functions smoothly when everything keeps expanding, what happens in a world that can't? And more importantly, who pays the price when expansion stops being possible, but the rewards don't change?